Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. What I would like to do today is go over 10 different companies that have increased their dividend in the January up until now, beginning of January up until now. So there are 10 different companies all increasing their dividends. Some of them are have a buy rating right now, some of them don't, so you're going to have to do your own research and so on. Before we get to the video, I would like you to subscribe to the channel. Of course, like the video because that makes a huge difference, as well as of course joining us in the Patreon account where you get access to all the buys and sells, dividend trackers, the Sharia compliant investing ebook, and the access to the Discord, inshallah. Before we get to the video, I want to mention a couple of things. So Lind have actually reported their earnings today, 6th of February. And as you can see here, in terms of EPS, it was a beat. In terms of revenue, it was a beat. And the stock is right now up about 4-something%, which is contrast in comparison to what we basically talked about last night, where we talked about air product and chemicals, and which was down 14%. And this one is right now, it's about 4% up. So that's the difference between basically, what these people think. Although it was a beat, but it was by, as you can see, not much in terms of EPS and so on, and the guidance was actually basically what they kind of expected. So anyway, that's one of the companies. The other one that has actually also reported was Cummins as well. This one, in fact, it was not a beat. Okay, if I show you here, so they missed it in terms of revenue, but in terms of EPS, but in terms of revenue, it was actually a beat. So this down, this up. But I think they guided higher. They must be, because they were expecting maybe worse revenue decline, maybe more than 5%. Because if you look at it, the stock is actually up quite a bit, for almost 4%. So it's interesting in comparison. One actually has reported lower, but it still actually went up quite a bit. So anyway, I'm gonna do some videos on that maybe next couple of days, just to look into the whole, give you a full picture. But for now, let's get on with the video. Now, as you can see, the latest increase is the bit that we're interested. I'm not going to read every single thing because I don't want to make the video too long, and there are 10 different companies, of course. But the first one is Chevron, and as you can see, it has a huge market cap of $287 billion, and the latest increase was about almost 8%, which is quite nice. The 5-year average is also 8%. And as you can see here, they've increased that dividend for 36 years in a row. You get $6.52 for every share of this company that you own. They do have a decent free cash flow here. The margins are not that bad either. Total return in the last 10 years of 6%. And then growth estimate next year basically is 12%, 13% almost. And then after that, there's a bit of a decline. Fairly valued right now, $172 per share is where they think the price should be. The next one is Church & Dwight, another company that I haven't actually spoken about in ages. 24/7, almost $25 billion market cap. It has basically in terms of moat wise is almost non-existent. But as you can see here, they have a very small dividend of 1%, and the latest increase was 4%, which is quite nice. The 5-year growth rate is compound annual growth rate of 5%, which is not bad at all. Normally 6% and above is nice, but 27 years of increasing that dividend. So they are a dividend aristocrat. You get $1.14 for every share of that you own. In terms of free cash flow, less than $1 billion, 13% growth total return in the last 10 years, 8% growth estimate for next year, 9% after that. Right now is very expensive because the price right now is 100. They're expecting to be about 64. That's about 57% up downside from where we are now. The next one is Tractor and Supply, the company that we've spoken about recently. It has a wide economic mode, only 25 billion market cap, dividend yield of 1.88. In terms of latest increase was almost 7%, and 28% in terms of the last 5 years, 13% of increase in that dividend. $4.40 is what you will get for every share of this company that you own. In terms of free cash flow, just below $1 billion. And in terms of growth estimate next year is 10%, then 5% every year after that. Fairly valued right now according to Morningstar. $212 per share is where the price should be according to them. So yeah, so right now is 230 something. So it has to come down a little bit in order to actually have a buy rating. Next one is Air Product and Chemicals. We talked about this in yesterday's video. 48.5 billion market cap, narrow economic mode, $3.36. So this is going up. It must be down today for that to be the case, because yesterday, let me see, yeah, there we go. So almost 1% down for the day. So that's probably why. So yeah, over 3%. So heading towards, you know, that 3.5%, which is, for me, is quite nice. I'll continue buying it. And the latest increase was only 1.1%. So again, because of this negative free cash flow, I'm not surprised that they just add in a little bit, because they don't want to lose that dividend aristocrat status while they go through this transition. But you get over $7 for every share of this company that you own. Safety is perfect in 95%. Remember, the highest you can get is actually 99%, so that's absolutely fine. Total return the last 10 years, 10%. Growth estimate next year is actually 9%. After that is 8%. So let me actually have a quick look. So just looking at the upgrades and downgrades in just the last couple of, basically just today, as you can see, this one is saying is actually maintains, this one actually maintains, this is the downgrades. So just these three have now so far acted on based on what we've seen. And as you see, the current price is $216 per share. The average price based on what they have actually, the analysts are saying, is $299 per share. It's about $300 per share. So that's quite nice upside from where we are right now. So it will be interesting. And as you can see here, 24% down and upside from where we are now. So 288, and these guys are saying 299. So not much of a difference in terms of that. So it's actually quite nice to see that. And then growth estimates for 9% and then 8% after that. That's definitely not bad at all, considering the stock went up, I don't know, 14% down last night. Sorry, not up, down to 14%. Kimberly-Clark is the next one, $40 billion market cap, narrow economic moat, $141 per share, dividend yield over 4%, which is absolutely huge, but 72% in terms of payout ratio. That's very, very high. REITs I'm okay with, but this is too high for me. Latest increase was 3.4, 5 years growth rate of 3%. 51 years of basically increasing that dividend. So this company is a dividend aristocrat. $4.88 is what they actually will pay you for every share that you own. 88% in terms of safety, which is absolutely fine considering 72% payout ratio. Profit margin, we're looking about 8%. Return on equity is quite nice. Return on invested capital about 31%, and $2.5 billion of free cash flow, 5% in terms of the last 10 years. Growth total returns of 5%. Growth estimate next year 7%, then 5%, which is actually quite decent, to be honest, for this company, because these are the, you know, all the consumer stable companies. You're looking for about 5% to 10% within that range. Some of them will be maybe 4%, 3%. But yeah, 11% discounted right now. $136 per share is where they think the price should be. The next one we're looking at S&P Global. This one did not basically raise much as well. $1.1 in terms of the increase. If you think about it, it has 143 billion market cap, 49 years of increase in that dividend. So the one more year they will become that dividend king. Annual payout $3.64. Safety was 99%. Profit margin is absolutely fine. Return on equity not great, but it's getting there. Return on invested capital of 8%. Free cash flow $3.3 billion. Total return in the last 10 years 20%, which is huge. Growth estimate next year they expect 14%, then 14% after that every single year. 14% premium right now. $395 per share is where they think the price should be. They're reporting, I think they're reporting tomorrow. I'll check that in a second. So we'll see what they report. Canadian National Railway is the next one, or CNI, 81 billion market cap, wide economic moat, $128 per share. Dividend yield of almost 2%, 44% in terms of the payout ratio, 7% latest increase, and then 5-year growth rate of 12%, which is quite nice. 27 years of increase in that dividend. Annual payout is $2.51 51 cents. Safety 97%, which is really good. So 90, I remember I said 99 is the highest, and 97 is actually quite good. Profit margin, return on equity really good. Return on invested capital not bad either, 14%. Free cash flow of 3.77%, and then 10% total return in the last 10 years. And growth estimate for next year is 13%, 6% after that. 10% premium right now, $115 per share is where the Morningstar says the price should be. Right now is $128 per share. Next one, Valero Energy Corporation, 47.8 billion market cap, narrow economic moat, $138 per share. Dividends over 3%, which is quite nice. Payout ratio is actually very, very low. Latest increase was almost about 5%. 5% in terms of the last 5 years. They haven't increased it a lot, so just 1 year. Annual payout right now we're looking at $4.28. 50% safety, which is very, very low. And remember, 60 below 60 is actually quite, it's not dangerous, but is you get into that dangerous zone. I do have 2 companies in my portfolio that are actually quite low, but this is 50% is actually quite low. Profit margin is not bad, is not great either. Return on equity 31%, 35%. And return on invested capital 30%, 11% in terms of $11 billion of free cash flow right now. Total return in the last 10 years 14%. Growth estimate next year is expecting decline of 13%, then 17% upside from there onwards. And growth positive 17%. Fairly value right now $128 per share is where they think the price should be. We've got 2 more companies. So the next one is Fastenal. This one, $39.7 billion of market in terms of market cap, wide economic moat. They've increased it by 11%, which is quite nice. So 13% in terms of the last 5 years, again, great. 25 years of increasing that dividend, so they are now a dividend aristocrat. I just need to check if they're actually in the S&P 500, because one of the criteria is the company has to be in the S&P 500, has raised that dividend 25 years without cutting it and so on, without stopping it, basically. You get $1.56 for every share that you own. Safety is 81%. Profit margin, return on equity, and return on invested capital, all absolutely wonderful. $1.2 billion of free cash flow. In terms of expectations for the next year, 9% and then 6% every year after that. Almost a 40% basically premium right now. 50 is where it is, right where they think it should be. Right now we're looking at about $69 per share, so it has to come down quite a bit. And the final company, as you can see, this one I actually come across recently, is I didn't think it was actually one of the Sharia compliance companies, because I think it's a utility company. It has a narrow economic, only $26 billion in terms of market cap, and increase was 5.6%. When you look at the 5-year growth rate, is basically, I think they cut their dividend not long ago, so this is only 1 year they've actually increased. Annual dividend of $1.52, 70% of safety, 37% in terms of profit margin, return on equity 3%, return on invested capital 5%. They actually have a negative free cash flow, 2% in terms of total return the last 10 years, which is absolutely terrible. Growth estimate next year is 4%. Growth estimate next 5 years is 7%, which is not bad at all. 28% from where we are now. And then $85 per share is where the price should be. Right now is $65 per share. Just to quickly show you from Sharia compliance side of things, there's no issues with a lot of them have in terms of business side of things. They do have 100% interest-bearing debt, not too high. This is the highest, I think, in this group. And then interest-bearing securities, not bad at all. It's not 60%. This one is only 6%, not 60. Okay. Other than that, that's absolutely fine. So all of them actually are Sharia compliant within basically what we're normally looking for. That's the 10 companies that have actually increased their dividend. I'm not saying go away and buy these companies. It's just for a bit of entertainment to see some of the companies. The ones that I actually own is this one here. I don't, and air product and chemicals. I'm interested in this one here as well. So Tract and Supply, I've been actually looking at it for quite some time. I would hopefully will come down. If it comes down to around this price, I might be actually interested to start a new position. And Canadian National Railway is actually a good one. I don't know which one to go for, but I'm looking at the basically CP and CNI, both of them. So hopefully we'll see. I'll let you know if I make a move in any of these companies. But as always, I really appreciate you guys watching these videos and liking and subscribing to the channel and everything else, as well as joining us on the Patreon. I hope you continue doing that. I hope you have a wonderful day. Assalamu Alaikum.